Hey, this is Brant from TradeGuild.net. We are going to be looking primarily at my proprietary indicator. It's called 3C, and this is basically what it looks like. And it works by looking for either confirmation or positive, negative divergences. And in the daily time frame, we're pretty much looking at institutional money. We're not looking at everyday traders. They don't have the power to accumulate like this or distribute in this manner. So we'll be looking at three different versions of 3C throughout. Each one is written differently. The reason for that is I like to use them for confirmation, and I don't want the same code and getting the same results. So I want to see a little bit broader perspective. So let's start just looking at the Dow Jones, and what I'm going to do is pull up a monthly chart, and we're just going to look at the events of the Dow, and we're going to go all the way back to 1917 or so. We're just going to change to a log chart, and with the log chart you can see the crash in 1929, this period throughout the 60s, where in 60s and 70s where the market pretty much went sideways, and the beginning of the secular bull market. People sometimes, I think, don't understand what secular bull market means. We haven't really seen a secular bear market, I wouldn't say, except in commodities in the 1990s. But a secular market is basically a market that would last from 5 to 25 years. And within a secular market, you'll have primary markets. And primary markets are what you're more used to hearing about: a bull market, a bear market. Those are your primary markets. But your secular market would be these long trends that we see, or this long trend here. So we've been in a secular uptrend or secular bull market for quite some time, since the early 80s. So just some of the important events that we're going to cover: 1929 over here, 1932, 1937, 1942, 1982, the crash of 87, the crash of 2000, this last bull market when it started around 2002, 2003, in that area, the top at 2007, and the big rally that we've seen, which I consider to be a bear market rally, in February of 2009, and where we are currently. So let's kind of get right to it. I'm going to pull up our first 3C chart, and we've kind of scrolled back to the events of 1929. I'm going to zoom out a little bit so you can see those a little bit more clearly. And you can see 3C works even way back then, because the concept of accumulation distribution hasn't changed, and human nature hasn't changed. And that's why technical analysis, when used properly, is not really about lines and overbought and oversold. It's about human nature, greed, fear, hope, such things like that. As we can see over here, we had an uptrend, and we saw the market making higher highs, 3C making higher highs, until this point in here, and I'll pull out the cursor, and you can see the market continued to make higher highs, but 3C continued to make lower highs. This is a period of distribution. Distribution can occur over a long period. It depends on how many shares are being distributed. People think that as a market's going up, that everybody's buying into it. Now, retail people, or the average Joe, are buying into it, but smart money has bought into it a long time ago. They accumulated back at much lower prices, and they are actually selling into it, and that's why we see distribution. If we take a look at a couple of different versions of 3C, we can see very clearly the top that formed in 1929, especially very clear right here, right before the crash. Here's one more version, and again you can see that distribution occurring over here as we make those higher highs in price. So that's a negative divergence, showing us distribution, and here's where we break down. If we were to use an hourly chart, 45-minute chart, or a 30-minute chart, we could probably pinpoint this pretty accurately. If we roll forward a little bit, we get into the period of 1932, where we saw some accumulation going on, and you can see the accumulation here. as prices making lower lows, we see 3C making higher lows and go into a leading divergence, which is the most powerful, above the readings over here where prices were much higher than they were at this bottom, and from there we see a rally. So that was an accumulative period, and we can see that in all of the versions of 3C, again over here, back here, and you can see that accumulation took place over a period of nearly a year. So as prices moved up, obviously they were selling. Now their average price, they could start accumulating back here, but their average price would be much lower, being that they accumulated down here below $50 on the Dow Jones. And we scrolled forward, and now we're looking at 1937, where we saw another top take place, and again, as we see higher prices, we also see higher highs in 3C. At this period, we start to see the distribution, and when we get to this top over here, we've seen quite a bit of distribution that's gone on for almost a year. We break down, and again we have a price up here which is much higher than it was back here, but the 3C reading is much lower in comparison, so that's a relative divergence. So again, we see another breakdown there. 1938 over here, you can see accumulation taking place at this bottom, which almost looks like a kind of an inverse head and shoulders at a very radical angle, and then again a move up, and over here we have confirmation because we're making higher highs in price and higher highs in 3C, so that's confirmation. Here we have distribution, here we have accumulation. You can pause the video and just take a quick look at that. I've gone ahead and scrolled forward to 1942 where we saw a bottom, and again we see that positive divergence over here where prices are moving down, the indicators moving up into the bottom. We actually even start to see a leading divergence here, and price took off from there. We see confirmation of the trend up until about this point, and then we start to see divergence in 1943. So basically distribution is occurring in 1943 there. We could roll forward a little bit and just see what happens here. And you can see we didn't make any higher highs over here. So we have a negative relative divergence, and price headed down from there. Lower lows, and we have lower lows here. So we have the concept again of confirmation of this downtrend. I'm going to go ahead and roll forward again, and we're going to take a look at another time period. And here we're looking at the time period, really what I want to show you is around 1982, 1983, where we start to move into this secular bull market. The market had pretty much gone sideways for the most part before then. You can see, again, clearly a divergence here at the top, where 3C has just gone down. So there's distribution there. Smart money basically selling into demand as the rally continues. So dumb money, that would be us, we're buying while smart money's selling into that demand. 1982 over here where we hit this bottom, you can see there's been a period of accumulation over here, and if we scroll forward, what we'll see is the breakout around 1983. We move into higher prices, there's distribution as you can see, and then we get that move down. Over here we're going sideways a little bit, and now we start to see some confirmation in the indicator. What I'm going to do is just roll forward to another event, which is 1987. You can see we have nice confirmation this whole time. There's distribution right there, and as we move forward, there we go. There's that dive that we saw in 1987. You can see, first of all, distribution occurring throughout this period. We did get a higher high in here, but if we zoom in close, we can see the ultimate highs were really made over here, and this is a very sensitive indicator. So the ultimate highs were made over here,